Hello, and welcome to the first and potentially only presentation from the boardroom. I am trying this out. I do not know how it's going to go. I hope well. Who knows? But today we're going to look at the difference between exchange traded funds and individual stocks and take a look at how those returns might compare and how just sort of the average person that's out in the world, may want to invest some cash for their retirement or to make a big purchase or just to put their money in something that's actually going to give them some money back uh, as the as time goes on, because we know that most likely it's not going to come from a bank account. Uh, as always, this is not investment advice. This is for entertainment purposes only. Always consult an investment professional or do your own research before making any investment decisions. Remember to always thoroughly research anything that you're going to put your money into, whether it be stocks, bonds, or anything else really. All right, so jumping off. So let's look at exchange traded funds, right? So for the purpose of this examination, the presentation, we're going to look at ETFs that track very broad indexes like the Standard & Poor's 500. So Standard & Poor's 500 is the 500 largest companies that are traded in the U.S. NASDAQ, which is going to be more technology focused stocks, and the Russell 2000, which is more mid and small cap stocks. So maybe not, your household names, but this tracks 2,000 of those organizations that are publicly traded. Generally speaking, ETFs are broad based, so they hold a multitude of different companies within them, and they're very well diversified. They're generally passively managed by a professional team. They have lower turnover of funds. So, whereas a mutual fund may turn over a significant portion of their fund every year and distribute out, capital gains or dividends or whatever it may be, which is going to hit you on the tax side. ETFs generally try to just kind of hold on to everything that's in the fund, and they don't want to hit you with, you know, tax income or income that's going to affect your taxes at the end of the year. They have generally speaking, this is all very general, lower fees. So whereas a mutual fund may charge you 1 point something or 0.8 something or 0.9 something, ETFs generally charge you 0.0 something or 0.1 something. And they're traded intraday, so you know exactly where they're trading. You can look at them up on your computer and you know exactly where the price is, whereas a mutual fund would be priced at the end of the day after the market's closed. Individual shares are exactly what they sound like. They're individual shares, so you're buying the company. So if you take $100, you put in an ETF, you're pretty much saying, I'm going to buy a whole bunch of stuff that is going to track some sort of certain index or basket of companies. Whereas, if you take $100 and you put it in a single company, you're saying, all right, well, I hope this goes well because I'm just buying this thing, and it may go up and may go down, as an ETF may as well. But, they may have a stock split, they may have a dividend, but you're pretty much betting all your chips on this one individual share. So whereas an ETF may have, Boeing, JP Morgan, Google, and, whatever you name it, Ford, right? You could put, or you just put all that money right into one share, and you're hoping that it does well. You may get a dividend, you may get if the stock goes up, you may get a stock split, you get more shares. But yeah, it's pretty much you're just buying one share in a company. Duh. So it's our investing grandpa. He's very popular. He's a guy from Omaha. His name's Warren Buffett. He's going to kind of set the stage for everything that we're going to be talking about, more or less, especially in the side of fees, which we're going to get into. But his quote reads, "Now, to my bet in its history in Berkshire's 2005 annual report, I argued that active investment management by professionals in aggregate would over a period of years underperform the returns achieved by rank amateurs who simply sat still. I explained that the massive fees levied by a variety of helpers would leave their clients, again in aggregate, worse off than if the amateurs simply invested in an unmanaged, low-cost index fund." And this is pretty much what he's talking about, right? Like this is historical S&P 500 performance. This goes back to 2016, but if you were to extrapolate this out to the beginning of the index, you'd see something very common to this, right? Like, 2020 gave us a nice little dip thanks to COVID, but on the average, it goes up and to the right, which is, as an investor, you're always looking to see. You get some bumps along the way. It goes up, it goes down, it goes up again. But yeah, I mean, if you're investing for the long term, things like these don't really matter, because then you know, a year later you're back up, you're back into the green, and you're heading in the right direction. So, what Warren Grandpa Buffett was talking about was this examination that he did in the 2016 annual investor letter. So he pretty much went out. He said to the public, I would bet any professional investor, any like a a certain sum of money, that they cannot beat the performance over a 10-year period of the S&P 500 index. And this is just an index fund. It's nothing. We're gonna get into those in a little bit, but it's just one of these things where you set and forget it. You get charged low fees. You're tracking a large index. So what happened is that this individual came to him and said, "Well, I put money in fund of funds, and that's like my job is I find money and I put them in fund of funds." Now, fund of funds is pretty much, somebody comes to this fund of fund and they say, "Hey, I got X amount of money. I want you to find me hedge funds to put my money into," right? So they looked at 5 different fund of funds, and those 5 fund of funds invested into over 100 hedge funds underneath them. So, the money flows to the fund of funds. The fund of funds then releases it out to these investors. The fund of fund is almost like a gatekeeper and headhunter for money, and they pretty much say these are the hedge funds that we would suggest. And yeah, so the underlying hedge fund takes pretty much, I would imagine, I don't know for sure, but very standard in the industry is a 2 and 20. So if you give them $100,000, let's say, they're going to take 2% right off the bat. That's what they are taking right off, and then they're going to keep 20% of whatever they make, and then the fund to fund, who's above that, is also taking money for their finder's fee, let's call it. And you can see at the end of the 10-year period, the results were not great in relation to just buying a S&P 500 index, which returned 85.4%. So, in his infinite wisdom, Grandpa Buffett was right again. And now getting into my own blithering idiocy. Because the list is endless, but these 4 stocks in particular, are just a perfect example of how you try to act smart and you try to think that you're going to find some stocks that are going to outpace the market. You can think that, you have a great investment theme and that everything's going to go well and you're the smartest guy in the room. So this black dotted line here is the S&P 500. That's our benchmark. And I got DocuSign, Nike, Vail, which is the mountain, the ski mountains, and BioNTech, which is a pharma technology company. It's hard to really. It's like biotech. It's a biotech company. And I looked at it, the 3-year returns here, because anybody could have a good year. Let's see, like outside of a consistent track record, right? Because you're probably not going to buy a stock and hold it for 1 year. You want to hold it for probably a good amount of time. At least that's how investing should be working, right? You don't want to be checking in and buying stuff and selling stuff every single day. And yeah, it did really poorly. And yeah, during this period, 78.55% is what you got if you just put your money into the S&P, interest in the index. The index returned that. Whereas, the best performer here is DocuSign. It returned 25.77%. So you've lost out on pretty much 52 and some odd percent of returns there. So that was dumb. It only gets worse from there. A 5 year, it's the S&P 500 was up 83. I'm such an idiot. S&P 500 was up 83.2%. Everything else is down. It's negative. In a 10-year, the S&P is up 230.74%. The only shining star here is BioNTech, and that was up 578.8%. But that was primarily driven by kind of COVID. And yeah, if you weren't holding it then you probably weren't going to do such a hot job, a couple years later, as we saw. So, the worst thing that you can do is you buy a stock and you kind of hold it, you're hoping, and you're like, oh, I don't know, like this should be good. And then you realize that this whole bull market is run right by you. You haven't, you put your money in losing horses here that have not returned what, you would have gotten if you just stopped trying to be so smart and you put it into an index fund. And that makes you a donkey. And you don't want to be a donkey because that makes you an ass. I've been an ass before. That's not great. So, yeah, that's not so hot. So let's go into index investing now. So we got VOO, which is Vanguard's S&P 500 ETF. That charges the investor 0.03% to hold it. That's their fee. So if you put $100 in, they're taking $3. It seems like a pretty fair trade to me. SCHB, that's Schwab's U.S. Broad Market. That charges you 0.04%. SCHX, that's their U.S. Large Cap. That charges you 0.04% as well. You got iShares Core S&P 500 ETF. That's 0.03. And then you got State Street Spider Portfolio S&P ETF. That charges you 0.02%. And I mean, the results kind of speak for themselves, don't they? I mean, like the S&P 500 is up and to the right, and everything, with the exception of SCHB, just marginally, has tracked that and given you back, what the index has done, which it should, right? Like, because like this is supposed to track this. So like, if you had these like wild things there's wild differences, then you would say, well, this is not really indicative of what the index is doing. But, as you can see, it's very indicative of what the index is doing. If you just kind of bought one of these low cost things, then, you could be sitting pretty and not being negative when everything else is positive like I am. Donkey. That's donkey time. You don't want to be donkeys. You want to make money. It's good for you. It's good for your family. It's good for everybody. You go to the 5 year, just about the same. You're tracking S&P 500. Everybody's having fun. Everybody's doing well. You take $10,000, you put it in there, you made $20,000. Congratulations. You double in your money. It's fun times. Glad I missed it. 10 years, put $10,000 in. Again, everything's just kind of tracking here. Now you're up 39.18 thousand. So you're up $39,000. So right off of your $10,000 investment, which really is just kind of, again, like the market's going to give you what it's going to give you. You can try to be smart and try to outplay it and try to think that you're going to get some sort of edge, and that you're going to, know something that somebody else doesn't. But, going back to this example, it's going to give you what it's going to give. And what it gives you isn't that all that bad, right? So like, let's just take what it's going to give, and then we can kind of put our money in there, reinvest if you want to reinvest any sort of income that the fund gives you, or any sort of dividends that you receive, or anything like that. And maybe, the fund splits, or things like this. And then, at the end of 20 years, you should be looking pretty. So, yeah, that is pretty simple stuff. And I don't know why we make it more difficult. Everybody's got a PhD and a CFA and an MBA. And it's just kind of that simple, folks. Yeah, unless you got some sort of big brain and you're going to be watching the stock market every single day and charting performance and seeing what's going to happen. For the average Joe, even myself included, as we could see, you know, taking the index and just kind of taking what it gives you is not necessarily a bad thing, because when you try to get smart and you try to get your money in all these names that you don't necessarily understand, and you hear it from some guy on the street, or CNBC's got some sort of blurb about it, or you read about something in the journal, so a lot of times it could backfire on you, and that makes you a moron. And you don't want to be a moron. There's worse things to be in the world, Jeffrey Epstein, but you definitely don't want to be a moron. So don't be a moron. This is my major advice to you, is don't be a moron, especially with your money. You need it. You like it. You want more of it. So that's always good. It's always good to have more money. It's rarely ever a bad thing. So yeah, that is the first edition of this. I don't know if I'm ever going to do it again, but I'm going to put it online and see how it goes. And that's been the boardroom, baby. So, love you all. Stay golden. And keep on being beautiful babies.